In 2025, the median American home lost something more significant than value. It lost a buyer. Not because demand disappeared, not because the economy collapsed overnight, but because the mathematical relationship between what homes cost and what people earn has broken in a way that is no longer cyclical. It is structural. And the people responsible for explaining this to you have a financial interest in making sure you never understand it. This is not a housing correction. It is not a temporary affordability squeeze waiting to resolve itself when the Federal Reserve pivots. What is happening right now in the American real estate market is a system-wide repricing event, driven by four compounding forces that have never converged simultaneously in the history of this country. And the silence from the institutional press is not accidental. It is engineered. Before we walk through exactly how this repricing is unfolding, and exactly which institutions are sitting on losses they have not yet disclosed, understand one thing. This analysis is about incentives, capital flows, and the mechanical consequences of leverage. It is not about fear. Fear is what they sell you to keep you distracted from the data. The data is telling a completely different story. Let us start with the number that no mainstream financial outlet wants to put in a headline. The total unrealized loss sitting inside the commercial real estate portfolios of American regional banks is currently estimated at between $600 billion and $1.2 trillion, depending on which valuation methodology you apply. That range is not an accident. The width of that range exists because the banks themselves are actively resisting the kind of transparent mark-to-market accounting that would force those losses into the open. They are using an accounting framework called held to maturity and extend and pretend loan modifications to avoid recognizing what any honest appraisal would reveal. The buildings backing these loans are worth dramatically less than the loans themselves, and the gap between those two numbers is being quietly filled with time, optimism, and your deposit. The commercial real estate market in the United States is valued at roughly $21 trillion. Office properties alone represent approximately $5 trillion of that figure. Since the beginning of the remote work transition in 2020, office utilization rates in major metropolitan areas have stabilized at roughly 50% of pre-pandemic levels, according to data from Castle Systems, which tracks building access card usage across tens of millions of workers. This is not a temporary adjustment. 5 years of hybrid and remote work patterns have permanently altered the relationship between corporations and physical office space. The corner office is no longer a status symbol. It is a lease liability. The consequence of 50% utilization across a $5 trillion asset class is not a 50% price decline. It is worse than that, because real estate is not a liquid market. It is an illiquid one. When transaction volume collapses, as it has, the handful of deals that do close set the comparable prices for everything around them, and those comparables are devastating. The former AT&T tower in downtown St. Louis sold in late 2024 for $3.6 million. The same building transacted at $25 million in 2006. That is an 86% decline in nominal terms. Not adjusted for inflation, not adjusted for any macroeconomic complexity. Simply, the building that sold for $25 million is now worth $3.6 million. There are hundreds of comparable transactions unfolding in secondary and tertiary markets right now that are not getting the same press because there is no viral story attached to them. The aggregate loss is simply being absorbed quietly by the balance sheets of regional banks who have no mechanism to surface it without triggering the exact panic they are trying to prevent. This is the fundamental trap. To reveal the truth would be to cause the collapse they are trying to avoid, so the truth stays hidden until it cannot. Now let us follow the capital flow that created this problem, because understanding how we arrived here is the only way to understand why the resolution will be so structurally disruptive. Between 2009 and 2022, the Federal Reserve held the federal funds rate at or near zero for an unprecedented 13-year period, interrupted only briefly by the shallow hiking cycle of 2017 through 2019. The explicit logic was economic stimulus. The practical consequence was a 13-year subsidy for debt-financed speculation. Borrowing was essentially free, and when borrowing is free, the rational response is to borrow as much as possible and deploy it into yield-generating assets. Real estate, with its predictable cash flows and tangible collateral, became the primary destination for this capital. Commercial real estate lending exploded. Office towers, apartment complexes, retail centers, and distribution facilities were acquired at capitalization rates, the ratio of income to price, that compressed to historic lows. A building generating $10 million in annual income was trading at $250 million, implying a 4% cap rate, because the cost of borrowing to buy it was 3%. The math worked as long as two conditions held. Rates stayed low and occupancy stayed high. Both conditions have now failed simultaneously. The Federal Reserve raised the federal funds rate from near zero to 5.5% between March 2022 and July 2023, the most aggressive hiking cycle in 40 years. The 10-year Treasury yield, which anchors commercial mortgage pricing, moved from 1.5% to over 4.5%. A building acquired at a 4% cap rate with debt costing 3% is now attempting to refinance debt that costs 7 to 8%. The income generated by the building has not increased enough to cover the new debt service. In many cases, the income has actually declined because tenants are downsizing or not renewing leases. This creates a condition where the building is mathematically insolvent at current interest rates. The equity is gone. In many cases, the debt itself is impaired. This is the maturity wall. Over $1.5 trillion in commercial real estate loans are scheduled to mature by the end of 2026. These loans were originated in a zero-rate environment. They are now facing refinancing in a 4 to 5% rate environment, assuming rates cooperate. The buildings backing these loans cannot generate enough income to qualify for the new loans at these rates. Lenders know this, borrowers know this, regulators know this. The public does not know this because the institutions who should be explaining it are the same institutions sitting on the losses. The regional banking system is the critical linkage here that elevates this from a real estate story to a systemic financial story. National banks like JP Morgan Chase, Bank of America, and Wells Fargo hold diversified portfolios with significant consumer lending, investment banking revenue, and global operations that dilute their commercial real estate exposure. Regional banks do not have that diversification. According to data from the Federal Reserve and FDIC filings analyzed by multiple independent research firms, regional banks with assets between $1 billion and $100 billion hold approximately 70% of all commercial real estate loans outstanding in the United States. That concentration is not a risk footnote, it is the central risk of the entire banking system. When New York Community Bancorp reported its fourth quarter 2023 earnings and disclosed unexpected losses tied to its commercial real estate portfolio, the stock fell 60% in a matter of days. That was not a one-off event. It was a preview. NYCB had acquired a substantial portion of Signature Bank's assets when that institution failed in March 2023, concentrating its exposure to New York multifamily real estate at precisely the wrong moment. The losses it disclosed were not unique to NYCB. They were representative of conditions across dozens of regional institutions that have not yet been forced to make the same disclosure. The mechanism for suppressing these disclosures is called loan modification. When a commercial real estate borrower cannot meet their debt service obligations, the bank has a choice. Foreclose, take the property onto its books, and recognize the loss. Or modify the loan terms, extend the maturity, reduce the interest rate temporarily, and classify it as performing. The second option allows the bank to avoid the loss recognition, maintain its capital ratios on paper, and hope that interest rates fall before the extension expires. The Office of the Comptroller of the Currency and the FDIC have both published guidance discouraging excessive loan modification as a tool for hiding credit deterioration. But the incentive structure is so powerful that the practice continues. Banks that recognize their losses face capital calls, dividend cuts, and stock price declines. Banks that defer their losses face none of those consequences immediately. The rational choice for bank management is to defer, regardless of what it means for the eventual size of the loss. This is extend and pretend, and it is operating at a scale that dwarfs anything seen during the 2008 financial crisis. But extend and pretend has a mechanical limit. Loan modifications typically extend maturities by 12 to 24 months. That clock is running out for the wave of modifications granted in 2022 and 2023. The first major refinancing deadlines are arriving in 2025 and 2026. When those deadlines hit and the modifications expire, the banks will be forced to make the binary choice they have been avoiding. Foreclose and recognize the loss, or lend new money into a deteriorating asset to extend again. Both choices have consequences that cannot be indefinitely deferred. The insurance market is adding a second layer of pressure that receives almost no institutional coverage but is actively destroying property values in the most affected markets. State Farm and Allstate both announced withdrawal from new homeowner insurance policies in California in 2023, citing wildfire risk and reconstruction costs that exceed their actuarial models. Farmers Insurance similarly reduced its California footprint, non-renewing approximately 100,000 policies. In Florida, the collapse of a dozen private insurers over the past 3 years has forced over 1.4 million policies into Citizens Property Insurance, the state's insurer of last resort, which is now so undercapitalized that a major hurricane season could trigger an assessment on every policyholder in the state to cover losses. The Florida legislature has attempted multiple rounds of insurance reform, but the underlying risk, driven by construction costs, litigation costs, and climate exposure, has not been addressed by legislative action alone. The financial consequence of insurance withdrawal is not gradual, it is binary. If you cannot obtain insurance on a property, you cannot obtain a conventional mortgage on that property. Fannie Mae and Freddie Mac, which purchase the majority of residential mortgages originated in the United States, require continuous hazard insurance as a condition of the loan. A property that becomes uninsurable does not simply lose value, it loses mortgage eligibility. And a property that cannot be financed with a mortgage can only be purchased with cash. Cash buyers, faced with the operational risk and insurance uncertainty of an uninsurable property, demand discounts of 30 to 50% below comparable insurable properties. This is not a gradual repricing. It is a step function collapse in value that occurs the moment the insurance policy is canceled. In parts of coastal Florida, inland California fire corridors, and increasingly in Gulf Coast communities exposed to hurricane intensification, this is not a theoretical risk. It is the current market reality, and it has not yet been incorporated into the appraisal models used by regional banks to value their collateral. The unrealized loss embedded in insurance-impaired collateral is a separate parallel hole in bank balance sheets from the commercial real estate maturity wall, and the two are converging on the same timeline. The residential market is experiencing a different but related form of structural stress built around the lock-in effect, which has been extensively documented by economists at the Federal Reserve Bank of San Francisco and the National Bureau of Economic Research. When mortgage rates move from 3% to 7%, homeowners who financed at 3% face a brutal economic calculus if they consider selling. Selling their current home and buying a comparable replacement home would require them to exchange a 3% mortgage for a 7% mortgage on a similar principal balance, potentially doubling their monthly payment. The rational response is to stay, and that is what millions of homeowners have done. Existing home sales volume in 2023 fell to the lowest level since 1995, according to the National Association of Realtors. The market froze. A frozen market does not mean a stable market. It means a market in which price discovery has been suspended. The transactions that are occurring are distressed sales driven by what analysts call the 4 Ds: death, divorce, debt, and displacement. These forced sellers have no choice but to accept market prices regardless of their carrying cost. The prices they are accepting in the limited transaction volume that is occurring are the only honest signal in a market otherwise characterized by artificial immobility. The second-order consequence of the lock-in effect is labor immobility. Workers who cannot afford to sell their homes cannot relocate for new employment opportunities. This creates geographic mismatches between labor supply and labor demand that suppress productivity and wage growth in ways that do not appear in any single economic statistic, but exert continuous downward pressure on economic dynamism. The housing market freeze is also a labor market freeze, and no one in the institutional economic commentary is connecting these two dynamics with the clarity the data demands. Meanwhile, the inventory that does reach the market is increasingly coming from a segment that received almost no analytical attention during the pandemic boom: institutional single-family landlords. Between 2012 and 2022, institutional investors, including Invitation Homes, American Homes for Rent, and various private equity vehicles, acquired hundreds of thousands of single-family homes in Sunbelt markets, including Phoenix, Atlanta, Charlotte, Tampa, and Dallas. The investment thesis was straightforward: buy at scale, rent at scale, benefit from home price appreciation. The thesis worked brilliantly when home prices were appreciating 10 to 20% annually, and rental demand was strong. It is under increasing pressure now that home prices have plateaued, rent growth has turned negative in many of those same markets, and the cost of financing the portfolio has increased. Invitation Homes, the largest institutional single-family landlord with approximately 85,000 homes, reported declining renewal rent growth in its most recent quarterly filings. The same trend is visible in the earnings of its closest competitors. When yield compression meets rising operating costs, the institutional landlord faces the same calculus as any other leveraged investor. If the asset is not generating sufficient return on capital, capital should be redeployed. And when the largest owner of single-family homes in specific markets decides to become a net seller, it adds supply to markets that have already seen their demand foundations weakened by affordability pressure. The unwinding of the institutional single-family trade is not a stated policy at any of these companies, but the directional pressure in their financial results points to exactly that outcome, and the markets most affected have no mechanism to absorb that supply at current prices. The apartment market, which was positioned as the safe harbor alternative to office, is now showing its own structural stress that the financial press has been systematically underreporting. During the pandemic, multifamily syndicators raised enormous amounts of equity from retail investors and deployed it into apartment acquisitions at compressed cap rates using floating-rate bridge debt, typically structured as a 2-year loan with extension options. The assumption embedded in every one of these deals was that interest rates would remain low, rents would continue rising, and the property could be refinanced into permanent agency debt or sold at a profit within 3 to 5 years. All three assumptions were wrong simultaneously. Bridge loan rates, tied to the Secured Overnight Financing Rate, or SOFR, increased from approximately 1.5% to over 5.5% within 18 months. A deal underwritten at a 6% return with 2% debt costs was suddenly confronting 5.5% debt costs on the same income stream. The deal went from marginally profitable to deeply cash flow negative overnight. Syndicators found themselves in the same binary position as office landlords: inject new equity or hand the keys to the lender. The difference is that apartment syndications were sold to retail investors, not institutional ones. Individual accredited investors who allocated $50,000 to $100,000 to these deals were told they were investing in a stable income-generating asset class. Many of them are now receiving capital call notices asking for additional equity contributions to avoid foreclosure. Some are choosing not to fund those calls, which accelerates the foreclosure timeline. The TREP Commercial Real Estate Data Service has tracked a significant increase in distressed multifamily loans in markets, including Phoenix, Austin, and Nashville, precisely the markets that experienced the most aggressive pandemic-era rent growth and subsequently the most aggressive institutional acquisition activity. This is the mechanism by which the commercial real estate crisis is making contact with the retail investing public, not through stock market volatility or bond market disruption, but through direct ownership of impaired assets whose true condition was obscured by the opacity of private market accounting. The municipal finance dimension of this crisis is the least reported, but potentially the most consequential for ordinary Americans who have no direct exposure to commercial real estate. Commercial properties are assessed for property taxes based on their market value. In cities like San Francisco, New York, and Chicago, commercial real estate generates enormous property tax revenue that funds schools, police, infrastructure maintenance, and debt service on municipal bonds. When a building's market value declines 60 to 80%, the owner has a legal right to appeal the tax assessment, and those appeals are now being filed in record numbers. The Cook County assessor in Chicago reported a significant surge in commercial property tax appeals in 2023 and 2024. The San Francisco assessor has acknowledged hundreds of millions of dollars in pending valuation challenges. When those appeals succeed, which they increasingly do because the sales comps support them, the city loses the revenue. But the city's expenditure obligations do not decline at the same rate. Police contracts, pension contributions, infrastructure debt service, these are fixed commitments that were sized to a revenue base that no longer exists. The mathematical consequence is a structural fiscal gap that cities have three options to address: cut services, raise taxes on remaining taxpayers, or borrow more. All three options have feedback effects that accelerate the deterioration of the local economy and the real estate market it depends on. Detroit went through this sequence over a decade and a half, beginning in the mid-1990s. The time scale of that deterioration gave the country the illusion that it was a unique, localized event driven by automotive industry decline. What is happening now in San Francisco, Chicago, and portions of New York is not a slow industrial obsolescence. It is a rapid repricing of the single largest component of the tax base, occurring across multiple major cities simultaneously, with no mechanism to arrest it short of either a dramatic decline in interest rates or a fundamental reimagining of how cities use office space. The second of those options, conversion of obsolete office space to residential use, has received extensive political attention and almost no practical implementation. The barriers are structural, not political. Office buildings are designed for large floor plates with central HVAC, no natural light penetration beyond the perimeter, and plumbing concentrated in core stairwells. Converting them to residential units requires gutting the entire mechanical infrastructure, often including the foundation of the building, at a cost per unit that in most cases exceeds new construction by a significant margin. For any specific building where the conversion economics work, it is because the acquisition cost has fallen so dramatically that the combined purchase and renovation cost is below market residential value. That is the precise condition, deeply discounted acquisition, that banks are trying to avoid creating by refusing to force foreclosures. The policy conversation around conversion is therefore dependent on the very market clearing that banks are suppressing. You cannot solve the conversion problem without first allowing the price discovery that reveals which buildings are economically viable for conversion at what acquisition cost. And you cannot allow that price discovery without forcing the recognition of losses that regional banks are currently carrying as performing assets. The circle closes on itself. Watch the metrics that are actually moving right now. The Mortgage Bankers Association Delinquency Survey for Commercial Loans, the FDIC Quarterly Banking Profile for Unrealized Losses and Held for Investment Portfolios, the CMBS Special Servicer Transfer Rate, which tracks the percentage of commercial mortgage-backed securities loans being handed to the workout team, the CoStar Group Office Availability Rate, which has now crossed 23% nationally, the highest level ever recorded in data going back to the 1980s. These are not opinions. They are mechanical outputs of a system under pressure. They do not tell you when the inflection point arrives, but they tell you, with precision, in which direction the system is moving and how much distance it has already traveled. The Federal Reserve is watching the same data. Their own research staff published a paper in 2023 acknowledging that a significant portion of the regional banking system could face capital stress if commercial real estate losses were fully recognized. That paper used careful academic language, as Fed research always does. But the conclusion was not ambiguous. The system has exposure that has not been absorbed, and the mechanism for absorbing it involves either time, lower interest rates, or loss recognition. Time is running out. Lower rates have arrived partially, but not sufficiently to restore the refinancing math. Loss recognition is the remaining option, and it is the one the system is most structured to resist. What happens when the system can no longer resist it is not a mystery. It follows the sequence of every prior credit cycle resolution. Losses that were private become public. Institutions that appeared solvent become candidates for assisted resolution. The FDIC, which holds approximately $120 billion in its deposit insurance fund against a banking system with over $18 trillion in deposits, will need to make allocation decisions about which institutions to support and how. Congressional authorization of additional funds is probable but not guaranteed and not immediate. In the gap between the recognition of the problem and the arrival of the solution, there is a period of significant capital flight from the institutions perceived to be most exposed toward the institutions perceived to be safest. That migration is already underway. It is visible in the deposit flow data from the FDIC's quarterly banking profile. Large domestically chartered banks have been gaining deposits. Small domestically chartered banks have been losing them net for 6 consecutive quarters. The movement is not panicked. It is orderly and gradual. That is characteristic of a slow-developing credit deterioration rather than an acute liquidity crisis. But orderly does not mean inconsequential. Orderly capital migration under a sustained period of deposit loss is precisely the condition that precedes a forced resolution event for the institutions on the losing end of that flow. The data is speaking. The question is whether you are listening to the data or to the institutions that have a structural reason to misrepresent it. The American real estate market has not died in the dramatic sense that headlines suggest when they want to generate clicks. It has done something more consequential and more durable. It has reached a structural inflection point where the combination of rate normalization, insurance withdrawal, institutional deleveraging, municipal fiscal stress, and regional bank capital suppression have converged on the same asset class at the same moment. Each of these forces would be manageable in isolation. Together, they form a compounding system of pressure that does not resolve quickly or cleanly. The experts are not hiding this because they are malicious. They are hiding it because they are trapped by the same incentive structures that created the problem. The banker cannot mark the loan. The insurer cannot underwrite the policy. The municipal official cannot project declining revenues. The fund manager cannot report declining NAV. Each actor in the system, behaving rationally within their own incentive structure, produces collectively a suppression of information that benefits no one except those whose losses are being temporarily obscured. The process is not finished. The maturity wall continues rolling through. The insurance retreat continues spreading geographically. The municipal appeals continue accumulating. The loan modifications continue expiring. The data continues moving in one direction. The question for every person watching this analysis is not whether to be alarmed, it is whether to be informed, because the resolution of this cycle will create the most significant capital reallocation event of the past 2 decades. The distress that is currently being suppressed will eventually surface as price, and the price, when it surfaces, will be the opportunity. The people who understand the mechanics of where we are in this cycle will be positioned to respond to that opportunity. The people who relied on reassurance rather than data will be positioned to absorb the loss. This channel will continue tracking the specific data points, the delinquency rates, the modification volumes, the deposit flows, the insurance market withdrawals as they move. Not because watching numbers is entertaining, because in a system this complex and this interconnected, the numbers are the only honest voice left. If you found this analysis useful, follow this channel so you do not miss the next data point that the institutional press decides you do not need to know about.